Hi.
Hello. Thank you, Mukul. And today we are very fortunate to be joined by Mukul Chawla. And Mukul is partner and head of growth investing in APAC, based in San Francisco. We hope to get some insight into how you feel about the Japan venture market, where you see blossoms of innovation, and a bit about the chaotic markets that we are seeing right now. We hope to give founders and investors who are here some insight and new perspectives on new opportunities in Japan, what risks to think about, and also maybe some areas of improvement that we in Japan. So first, Mukul, would you be able to share a bit about yourself and also your team at KKR?
Sure, I'll introduce myself. Thank you so much for having me here. And I appreciate the opportunity to speak to you and your audience. As my introduction said, I'm partner and head of growth equity in Asia Pacific at KKR. Some of you may know KKR. We're a relatively long history of private equity practice, including in Japan. Although our growth equity efforts are relatively new, we are looking to partner with teams such as many people in your audience who are looking to build companies as a minority partner and support them in some of their growth and development. My background before this, I've been at KKR for less than 6 months at this point. For the prior decade, I built both the North America and global technology franchises at Temasek, based out of New York and San Francisco. And then before that, I was at Warburg Pincus in New York, again, focused on technology investing. So I've been in the technology investing space for just under 2 decades at this point. I should mention I was trained as an engineer and started my career writing software at Cisco Systems. So I was one of many folks out here who have who live in the trenches of building software companies. And in the early years, had the opportunity to both be a software engineer and product manager before I moved to the investing side of the house. So that's my background. We're fortunate as KKR to have a team on the ground here in Japan. We're very excited about the opportunity that the market has to offer. We've already made a few growth equity investments, in particular DataX and a company called NetStars. DataX is a marketing SaaS platform here in Japan. NetStars provides QR code-based payments to merchants here in Japan. So we've already started our activities here from a growth equity perspective. We have 3 people in our Tokyo office focused on growth equity in the technology space. So I'm hoping to partner with you at DNX and many others in your audience in the coming future.
Thank you so much, Mukul. We look forward to hearing more about your observations in the session. As investors who have seen the venture ecosystems and ventures in various geographies, including the Valley, how you see the investment opportunity in Japan. Just to give the audience some perspective, according to data in Japan, global VCs invested 85 billion yen, which is about 750 million in 2021, which is actually more than 3 times that of the year before in 2020. And global VCs account for roughly 25% of all VC funding in Japan. And this is more than double from past. Japan, we're not like a high growing country, not like India and China. So until recently, it was not common to see top funds like yours in the fundraising news. Would it be possible to get your thoughts on the Japan market and also in relation to other markets that you've been seeing?
But I think what we've been seeing over the last 5 to 10 years is a big change and a positive change in the availability and the development of talent that has ultimately fed this venture ecosystem, right? We're seeing the venture community a lot more excited about funding early stage ideas. So really, I think we've seen a very positive growth in the number of ideas that are getting both funded and accepted in the market. And I think that's a very exciting change to see relative to history. I think in time, although not today, things will get more competitive. But today we see, a few category defining companies in each category, relative to say the US or China, where a lot more companies tend to jump into the fray when a particular category gets kind of introduced to the market. I think we're starting to see, a smaller set, but a determined set of founders come into the fray. So I think it's a very positive sort of development that we've seen over the last, I'd say 5 to 10 years. I'd say this is a little bit more pronounced in SaaS, which is great. It's also quite pronounced in fintech. And I'd say the third category, which is evolving but not quite there, is are companies that are tethered to what I would call the broader Japan ecosystem, where Japan has unique capabilities, right? Deep tech, robotics, etc. Today most of those companies still remain the larger legacy companies in Japan. I think that category we're hoping to see develop more. But I think in SaaS and fintech in particular, we're starting to see a lot of interesting opportunity develop. So I'd say it's been largely positive. You also have a uniquely receptive public market, the mother's market for relatively young companies. I think that's a bit of a double-edged sword. On one hand, it allows young companies to get liquidity in public markets. I think on the other hand, sometimes being public can be a distraction for some companies that could actually have very long legs and perhaps benefit from growing in the private markets. So I think the ecosystem actually offers a great range of opportunities for young, growing and scaling companies. What we'd love to see is more companies who choose to sort of take the long road to bigger out. And I think, us as growth equity investors, doesn't matter which firm you talk about, I think stand supportive here for companies that are looking to take that path. We'd love to see a lot more of that in the Japanese ecosystem as well.
Thank you, Mukul. Are there any trends in Japan or elsewhere that your team or you can talk about?
Certainly, I think similar to the example that Jack gave, we paid a lot of attention to the relatively low penetration, despite the large economy that you have in Japan, the relatively low cashless penetration. And so, that became an area of interest that we followed, and we've done, we've made investments around the world as we went around and as we looked for capabilities in founders and management teams. I think one of the companies we came across was NetStars here in Japan, right, which we are very excited about, providing QR code-based payments to merchants, right? So a similar example where thematically we began top-down with a category that we believe is quite large in Japan, an opportunity that is quite large in Japan, clearly a very large economy. And as we kind of went through the range of companies that we saw, and we've made investments in this space globally, I think we came upon a team and an opportunity at NetStars, which we remain very excited about and speaks to sort of our one of our plays here in the Japanese markets.
Thank you. If I would like to also ask what Japanese entrepreneurs or Japanese corporates can, what you see as areas of improvement. As you know, Japan only has maybe roughly a tenth of the number of unicorns compared to other areas in Asia, much less than compared to the US. So we do understand that we have a long way to go, but as investors for you who have been seeing venture ecosystems elsewhere, would love to hear areas of improvement. Can I ask you, Mukul?
Sure, I'm happy to. So I'd say first I should start by saying we're obviously incredibly excited about where the Japanese ecosystem is, right? So these, I think, the things that I will describe, I feel are areas where it would only enhance the opportunity set for both founders, management teams, but also investors. I think the first thing I'd say is dream big, right? And I think, again, uniquely, Japan offers an opportunity for liquidity relatively early in the journey of a company. And what I would hope for Japanese founders, management teams, entrepreneurs is that, while that option is a very attractive one, it doesn't become a distraction from growing and building meaningful large companies, right? And I think that would be would be a very interesting sort of change. Not change. You already see some large companies being built, but I think more of these would be a good thing for the ecosystem. So I'd say dream big, don't worry too much, or don't hurry too much to get liquid in the public markets. The second thing I'd say is that, I think the Japanese market is actually quite large. And, while in some cases it might make sense to go to outside markets, the domestic market is enormously large in a number of categories. And so I'd say to a number of founders that focusing on the domestic market, tailoring your business models to this market, I think would be a better use of time and money in many cases than looking to go overseas, just given the size of the opportunity. One of the themes that I didn't mention is, the healthcare space, but the technology opportunity in the healthcare space, which is enormous here, right? I'd say that's an interesting space for founders to pursue. There are some legacy providers of technology in that space, but there's an incredible willingness to adopt new software, and I think it's a capability that I would encourage people to lean into. And then lastly, something I said earlier was, the point that a lot of the traditional strengths in Japanese technology, things like robotics, material science, and things like that, continue to remain in large companies. We haven't really seen them play out very much in the growth stage or the venture stage ecosystem. I think there's definitely an opportunity for companies, for entrepreneurs to step in, and for investors, candidly, to step into those and continue to encourage the development of those in a slightly different context than the large company context that they've been in. So all of these, I think, would be improvements to what is already a phenomenal and rapidly growing ecosystem, in my view.
Thank you, Mukul. So there's been a lot of change in 2022 in the US and the global markets. And I was wondering if we can get some of your insights, Mukul-san, on how that is affecting your way of investing, or your thoughts on your investment strategy.
Sure. I'll start by saying that the underlying fundamentals that we invest against are intact. I think you see a global, I'll call it an explosion in entrepreneurship, which is a very positive thing. You see the continued move of technology penetration. I think that remains a very positive thing. And I think at the end of the day, what we wouldn't want is to use a phrase here, have the tail wag the dog, right? We believe that the underlying fundamentals for a lot of these companies, including in Japan, remain very strong. So we remain very positive and very positively inclined to continue to lean into the opportunity set that we see here. Now, that being said, I do believe that the capital market change is a meaningful one that we've been seeing. And I don't think it's a temporary change. I do think there is a bit of a shift that will stick. And I don't. We could spend a lot of time talking about the macroeconomic moves here, but I think as it relates to the venture ecosystem, I think there's a few things that will change. I think we're seeing a little bit of a step back from the previously very active crossover type funds. I think we will see them step back, step away a little bit. I think that'll reduce some of the liquidity that we may have seen. We're also going to see, I think, a little bit of greater focus on, profitability. Those remain very, very important. I think companies that are unable to demonstrate sort of, contribution level economics and, whatever is a medium-term path to firm level profitability, I think we'll just find it a little harder to execute fundraising events in the market, right, public or private. I think the market's appetite for that has reduced somewhat. That, by the way, might engender more of an M&A opportunity. There may be consolidation that happens around some of those companies. And then lastly, I think valuations will likely adjust somewhat. I think the private markets have the privilege of not having sort of the day-to-day marks of a public market. But I do believe that you will see some of those adjustments play into the private markets. We're already seeing them happen. So I think those are, all three things that I described, right? I think will engender more discipline in the market. I think it may drive some rethink of valuations. I think we did see a somewhat frothy 3 to 4 years. We'll see the participants in the market shift a little bit. But I think what's important is high quality companies will be fine. And I think that's the important thing to take away here as well, that if you have a quality business model, you are going after a large profit pool, not just a large revenue pool, but a large profit pool. You have the ambition to build, you have the ability to retain and hire and retain talent, right? I think those companies will be fine. In fact, if anything, they may have the opportunity to buy some of their competitors that have not really worked their way through business models as thoughtfully as some of these leaders might have. So I think the strong get stronger. The market shifts a little bit. We remain extremely optimistic about the underlying fundamentals. But I also don't think this change in the public markets is a temporary one. I think it is something that is going to be sticky and is going to have some consequences for how we are in the private markets and also in the public markets going forward.
So maybe we're just coming back to the normal, and the last 2 years or so may have been the outlier.
I think so. I will say last few years, and again, not to get too macroeconomic on everyone, liquidity fueled such a massive rise in multiples that it became quite hard to distinguish between good fundamentals and not, right? It was just such a rising tide that lifted all boats. I think you're going to see a return to fundamentals. And I think in a sense, look, venture capital, growth equity, we've lived through many cycles. I think this is just another adjustment in a cycle. I don't think the underlying fundamentals, either of the opportunity for management teams and founders or for investors really change. But I do think the excesses that you rightly pointed out of the recent past might be behind us for some time.
Thank you. So we have a question from the audience. So I wanted to kind of blend that question into this topic. You mentioned the merits for staying private for a longer time, which would mean that you would require more, maybe growth capital. But Mukul, you just mentioned that the crossover funds funding may be much less than they were from 2020 to 2022. So in that sense, the question was, so does KKR, your investment stance, that hasn't changed in terms of if it's a quality investment, the amount or that has not changed?
So I'll speak for KKR. No, that has not changed. I think we are investors looking to back companies, and these alphabets keep moving around, but I'd say Series C, D, and beyond. Occasionally, we will make a Series B investment. So we truly believe that companies that are graduating from venture capital programs, right, we're unlikely to be doing Series A and B rounds or seed rounds, are companies that we stand ready to back. Our quantums have not changed. Our inclination to lean into the opportunity set has not changed. So we absolutely remain sort of on the course, if you will, or stay the course as it relates to funding, these emerging growth companies.
Can I ask a bit further? When you say they graduated from, venture stage, what do you look at?
Yeah, I think, look, this is again specific to KKR, so I'll speak to our practice. I think we are probably less smart when it comes to taking technology risks. So we're unlikely to be taking technology or product risk. We are usually inclined to take execution, go-to-market, scaling risk. And so the companies that we sort of see as having graduated from venture stage, if you will, are companies where they've kind of built out their product to a certain extent. They've demonstrated some level of product market fit. There is early revenue in the company. I think those are the kinds of companies that we consider as having growth equity risk and therefore ready for growth capital, where scaling, go-to-market, bringing them the right talent to continue to build out their businesses, oftentimes coaching and partnering with founders who may not have scaled companies to those sizes and beyond, where we can bring some resources to bear, are the kinds of companies we'd like to participate with. Now, the capital sizes at those points could be, on some cases, as if for us, a small end of a check size would be $40 to $50 million. And at the upper end, it could be much larger. It could be in the many hundreds of millions of dollars, if appropriate for the company. And what we would like to do, back to my point of companies staying private and us truly being partners, not just being investors for one round, we would love to partner with companies where we're not just investors in one round. We would like to be part of your journey. And so even if the first check that we deploy is a $40 or $50 million check, over time, those checks could be much larger. So really, it's a journey that we would want to be a partner with you in. But I think where we come in is after that point of sort of technology risk being behind you and some level of product market fit and sort of scaling being the principal sort of objective at that point.
Thank you. So DNX invests with KKR in one of our portfolio companies, DataX, and yes, we are very fortunate to have your team provide a lot of input and a lot of support in, thank you, and support together our portfolio companies. So thank you very much. Mukul, if I can ask you, so the question was, how can Japan produce more big companies like Google?
Sure. I think, first of all, I want to say Japan has produced great global companies. I don't want to, I'd be remiss if I didn't mention Sony and Fujitsu. 6 of the 10 largest robotics companies in the world are Japanese companies, right? So there have been incredible stories over the last 50 years of great companies, great global companies created out of Japan, right? So the Google of its time was perhaps Sony, which was a Japanese company. I think in all these cases, the same example can be taken of Google. I think companies need to lead with product leadership. So I'd say number one is product leadership. And that's an important thing to focus on. I think product leadership is where you start that journey. From there, it goes to a global go-to-market, which requires embracing global talent, which also requires embracing global cultures and being able to integrate them into a global company, which may be centered here in Japan. And then you scale from there. So I think it's a well-trodden path. I think it can absolutely be done. It's been done from Japan before. I think you need to start with product leadership and follow that up with embracing global go-to-market, which requires embracing global talent and global leadership as part of the organization. But it absolutely, whether in the automotive sector or in the electronic sector, Japan has done it before, and I'm fairly confident we'll do it again.
Thank you. We have just time for one more question. And so since we have been getting a lot of questions, if I can ask one more question, which is, maybe if I can ask you, Mukul, since you also look at PE, Japan has much more SMEs than startups. And it seems that SMEs have more investment opportunity. Will you still invest in startups more than like PE deals like SMEs?
Sure. So I don't think there's necessarily an either or, right? For a firm like KKR, we have the opportunity to invest across the board, and I think we will continue to do that. I don't think we have to choose. We're fortunate in that we go where the opportunity is. And what I'd say is it's not so much a question of the number, more SMEs, less startups, and so on. it really comes down to risk-adjusted returns, right? In our business, Jack's and mine, we're delivering returns to a pool of capital. And so for us, we need to find where the best risk-adjusted returns are. And I certainly believe that Japanese startups continue to provide enough such opportunities that we will remain active in that segment. So I don't think it's an either or. I think it's where the rewards are on a risk-adjusted basis. And I think for all the reasons that we've just talked about, and all the reasons why we're here and excited about the market, I think the startup ecosystem in Japan continues to provide that risk reward that we would be looking for.
Okay, thank you so much. So Mukul-san, on behalf of the DNX team, we are so thankful that you were able to make it out into Japan. And thank you so much for bringing such great insights in, and also, the way you frame the whole Japan opportunity and how you see, the market going forward. This was very, very insightful. I hope the audience has also enjoyed the session. 以上で、本セッションを終わりにしたいと思います。ご清聴いただきましてどうもありがとうございました。